Hello and welcome to today's ASX Investment Opportunities in Review live webinar. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Moving into a table of the custom watch list. So what I've done here is under watch list, come in here, select custom watch list, and I've added in the global indices. So we'll start today's recording just by sort of refreshing our memory on some of the patterns that are evolving at a macro level in global markets. So up on screen there is the NASDAQ. And this has really been one of the key drivers of the recent rally in the market has been the big tech companies. So the NASDAQ's rallied, as we looked at last week, from 6,800 up to around 7,600 points. And it would seem that it's pretty close to resistance at the moment. And when we go through the markets and have a look at the other patterns of the S&P 500 there at the moment, it found support here at around 2,500 points. We're now up to 2,800. If we look at it from a closer perspective, we can still see sort of the higher high and higher low formation, and for that reason you probably continue wanting to give the uptrend the benefit of the doubt. And as a reference for the way that I look at the market, I've put this line in place on the Dow Jones index, again highlighting that it made a higher high and then a higher low. So this 24,247 is a rising support level that I've shuffled underneath there. And just as a reference point for should this uptrend reverse and start breaking back down, I've put this uptrending support line here, really just as a trigger to remind me that if I see price action cross back below that, then I just need to start taking closer notice as to whether the market starts to close on the lows and struggle to move higher. But we're probably, a couple of weeks out from that. When you look at the shorter term momentum indicators, the stochastic's still quite positive. But we are mindful that global equities, excuse me, global equities trade on a very high multiple, and there is a lot of optimism already priced into equities. So moving on from the Dow Jones, looking at our local market. So we had that same high-low formation at 5,964, and we haven't gone on to take out the prior high, and that was really a function of this rally being the fact that our index has an overweight exposure to commodities, and oil and iron ore had a good rally throughout April and May, and created this high. At the moment, I suspect that our market probably struggles to go on to make new highs given the weakness in the banking sector and the miners looking full value. An area that I do think there's probably upside is some of these energy names, and we'll look at that during today's recording. Just continuing to move through here. So this is the ETF on the ASX 200. So if you just want broad-based exposure to all companies in the ASX 200, you can do that through the STW, and we can see there that around $57, $58 there's some resistance there, and we're just watching how that unfolds in the weeks ahead. The NASDAQ ETF, so this through one investment here in the NDQ, you get exposure to the NASDAQ 100, so the top 100 companies listed on the NASDAQ. The algorithm added this into the model portfolio. We had a recent buy signal there at $14.34, and it's now trading $16 odd. The equivalent across the S&P 500 is the IVV. So this is an iShares product, so getting exposure to the 500 biggest companies in the US through one investment. We last had an algo buy signal here at $3.36, and it's about 10% higher following that signal. Okay, so the format for today's presentation, what I wanted to do is show you how to isolate a particular ETF provider within the watch list. So we're going to look at the major providers, being iShares, BetaShares, the Spider ETFs, Vanguard, and so forth. So I'll just introduce you to that function. We'll look at the recent signals on the ASX over the last 7 days, and then conclude with a list of stocks to watch, which some of those names were covered last week, and we'll revisit those again today. So clicking on the watch list, coming into the full ETF watch list, which is ASX exchange traded funds. And we select that, and then up on the top here where you got this little filter, if you turn that on, so it'll go green, and then that drops down this extended search list below the headers here. And under name, if we were to start with looking at beta shares, for example, we type in beta, and it automatically isolates only the names in the watch list that contain that, and then we can click on the first code and start toggling through those as a way of starting to familiarize yourself with the different ETF providers on the market. So I won't, given that there's about 140 to go through here, I won't cover all of them, but I'll just get the process started on each of the main providers so you can get an idea of something that I suggest that you look at doing in your own time following today's recording. So the first one here is a new ETF that's been listed by Beta Shares, and this is a similar product to that STW that we looked at earlier, where the A200 gives you exposure to all 200 stocks listed on the ASX, and Beta Shares probably has one of the lower management fees, down at around 7 basis points for their management fee for giving you exposure to all 200 companies. Now, I think the relevance of sort of going through this today is that I'd encourage you to go into the model portfolio and add the ETF model portfolio to your email list, so you get notified of future changes to the portfolio where you do have either a high or low formation occurring in an ETF or a lower high, and I'll explain that further when I finish going through these. So okay, so let's just keep moving through these, and I'll comment on a couple of them. So this is a strong Australian dollar fund, so if you're bullish the Aussie dollar, gives you exposure to that. Australian equities strong bear fund. So Beta Shares is, I think, probably the only provider that I know of on the ASX that provides a double leverage ETF. So in this case, it's a short fund. So if the XJO goes down by 1%, this particular product goes up by 2%. We've had an algorithm buy signal, so it's been added into the model portfolio here, and it'll remain in the model until such time as it rolls over and makes a lower low, lower high, and then it'll be removed from the model. So when you see the strong bear or as part of the name, just recognize that they're a double the exposure. In America, you have ETFs that run at sort of 8 times exposure, but in Australia at the moment, I don't think there's anything beyond sort of 2 times exposure. So B-Bus. So this is a double short exposure to the US equity market. So as the S&P 500 falls by 1%, this would go up by 2%. The bear is just a single exposure, so meaning if the XJO goes down by 1%, this will go up by 1%. So seeing that it's missing that strong component of the name, so that strong component relates to it being that double exposure that I've been talking about there. Beta Shares Global Bank, so if you want exposure to all major global banks globally, this product can do that, and we can see here it was added to the model portfolio at around $6.40, $6.50 in the middle of last year, and for the most part it's performed quite well since that. A lot of these ETFs, you can get exposure to corporate bonds. The one we're looking at the moment is global healthcare. So through one investment, you get exposure to all the major stocks within the healthcare sector. There are currency ETFs, so Beta Shares Euro. So if you want exposure to the euro, you can do that. There's a number of equity income funds. There's a number of sort of enhanced dividend strategies. So these are the Beta Shares. So again, I won't cover all of them, but that's an introduction there. So let's go back to the watch list and have a look at another provider, which is iShares. Let's set this up again. So we click in here, iShares, and let's just start moving through a couple of these. So iShares Asia 50. So this gives you exposure to the 50 largest market capitalized companies in Asia. It was added to the model portfolio back here at around $60. And if we look at the history of this, it's really performed well across the last 5 years with a series of higher highs and higher lows. So again, if you were set up on the mailing list for changes to this model, the next time this index pulls back and creates a higher low formation, you'll get reminded that the stocks had a buy signal within it. Likewise, if it's in the model as it is at the moment, if it rolls over and makes a lower low, you'll get notified that the stock's being removed from the model portfolio. So moving through a couple of these iShare products, corporate bonds there, exposure to the BRIC, so emerging markets, so Brazil, Russia, India, and China, so all through one investment. Emerging markets, so just as a point of interest at the moment, you're starting to see some pressures appearing within the emerging markets, both in their currencies and in some of their equity indices. So it's an area that I think investors need to be a little bit mindful of. As US interest rates rise, the US dollar increases, we're starting to see some selling begin to develop in these emerging markets. So we'll continue to watch that and track that in our monthly strategy recording and the impact that that may have on ASX 50. So if we look at sort of the emerging markets, you can see there that it still hasn't had that rebound or recovery like what you've seen in the US equity market. iShares Europe ETF, so exposure to Europe equities, treasuries, global corporate bonds. So this is a dividend harvest, if you like, ETF, and a lot of these type of products provide lower capital growth but higher income. So again, more bond products, emerging market bonds. So iShares Hong Kong Index, I think this one's worth just stopping to think about. So if you want exposure to the Hang Seng or the Hong Kong equity market, you can do that through the IHK iShares. And if we look back at the performance over the last 5 years, the higher highs and higher lows, the algorithm's done a good job of sort of flagging the entry points into that. Global 100, so top 100 companies in the globe, and you can invest in that through a hedged or an unhedged strategy, as you can do with the S&P 500. You can have exposure to an increase in US dollar, or you can hedge that if you thought the Aussie dollar was going to move higher relative to the US dollar. S&P mid-cap ETF, so through these ETF products you can gain exposure to a small cap, mid-cap sector of the market with one investment, exposure into Japanese equities, small cap, so I spoke about the difference there, South Korea, and so on. So what that provider is iShares, so you might want to think about toggling through the rest of that list. So moving on from iShares, let's have a look at the Spider ETF products, and we'll just click on this, move through them. So global real estate, government bonds, the ASX 200 financials, excluding the real estate investment trusts. So if you just want broad-based exposure to all the ASX stocks that sit in the financials GICS sector, you can do that through this ETF. So the code there's OZF. And then likewise, if you just want exposure to the resources stocks within the ASX 200, you can do that through this product, the OZR. So this one here I find interesting, given my interest in the ASX 200. So this is the SFY, which is a Spider S&P ASX 50 fund. So through one investment, you can get exposure to all top 50 companies in the ASX. And where I think this is probably more of interest now than maybe it has been for a while is as the banks underperform, it drags down the value of this overall index. And there's probably a point in time where thinking about a basket investment into either the ASX 200 or the ASX 50 becomes a reasonable consideration for portfolios. So you're getting paid the full dividends and the franking credits through these investment funds. But my view is it's an area of interest and it's worth keeping an eye on. But yeah, my preference is still for individual stock exposure. But certainly there are opportunities from time to time where we allocate money, especially in these Asian markets and the SFY, where we've identified buying opportunities previously and made successful investments across these products. So the SLF gives you exposure to all the listed property stocks on the ASX, and we added this into portfolios at around this sort of $11.80 level following that algorithm buy signal. And again, if we look back over the last 5 years, the algorithm engine's done a pretty good job of identifying good entry points into this product. So that's the spider ones. Let's just move on and have a look at Vanguard. So fixed interest, again, Australian property securities, Australian share index, global aggregate bond index, international credit securities, diversified balanced index. So I don't follow too many of these Vanguard products, but there's something that you can go through, and if you find ones that you're wanting to know more information about, you can Google the fact sheet just by putting in the code and then fact sheet, and you'll be able to locate more information about the fund on the provider's website. So that's Vanguard. Who else we got here? UBS. So there's about 3 more providers to have a look at. So UBS provide a series of ETFs under the UBS IQ branding. And also you got Russell. So there's a handful under that branding. And finally, just to have a look at the ETFs, where we actually had an algorithm buy signal in one of these last week, which was this one here, the ZGOL. So I'll just click and go into there and we'll have a look at that one. So this is a physical gold exposure ETF in Aussie dollars. So what you're looking for here is gold to go higher and the Aussie dollar to go lower would be the optimal conditions for adding value to this product. And we've had an algorithm buy signal there at around that low of 16.28, and it's now trading marginally higher. But over the next month or two, we'll continue to track this as we'd expect that higher low formation to hold. And from a fundamental standpoint, the backdrop appears to be sort of the right conditions to see gold moving higher and the Aussie dollar moving lower. So what I encourage you to do, go into the watch list there, start by selecting the ASX exchange traded funds, which is the full list, and by default that's what it's going to look like, which will be about 140 ETFs that it loads in there. So they're all different providers, and the way we isolate those providers is by turning on that filter and then typing in the name there, and then you can toggle through that as a separate list. Looking at the ETF model portfolio, so if we click on model portfolio, come in here, go down to ASX ETFs, make sure that envelope's green opposed to grey, so make sure that's turned on, and you'll start getting email adjustments when ETFs are added or removed from the model portfolio. So if we have a look at the ones that have been added most recently, so I've clicked on the days held here, it's got the least number of days to the top. So one of the recent additions has been the O, which is the oil ETF, and if we have a look at this here, so it's picked up the higher low formation here at around $18, and this is pretty consistent with my view that I think energy remains an area that's likely to deliver some upside earnings surprise for the market. So you can either take a blanket approach through buying the oil ETF, like what we're looking at here by beta shares, or you can think about that as a confirmation to say, well, what stocks in the top 50 currently have buy signals that are in that energy space, and the likes of Origin Energy, Santos, Oil Search are the ones that come to mind. So moving back to the model portfolio, the BBOS, which is the short position on the Australian market, we'll have to wait and see how that plays out, but that's recently been added. This MOAT ETF, this gives you, I think it's almost about 98% exposure to US equities and leading market capitalization US stocks, which includes the tech sector. So this particular addition to the model portfolio there at $52 is performing well, and if we have a look at that in percentage terms, it's up 8.9% approximately from when it was added. If we continue just to have a look at a couple of these, so the Spider S&P World ex Australia, so it gives you exposure to all global equities excluding Australia, and it's hedged in Aussie dollar terms, and it was added to the model portfolio here at around $21.30. It's trading $22.90 at the moment. This is the double long US equity fund, which was added to the model here in March at around $14. It's now trading $16.74. We'll just have a look at a couple more through here. So the SFY, I think that was one that we looked at, being the ASX 50 fund. So it was added to the model portfolio probably at this point here at around $53, and that's now trading a little bit higher as well. So you can maybe go through this model portfolio, have a look at the recent additions, have a look at the percentage gains. You can actually click on the code and toggle through all the ETFs that sit in the model portfolio, but I think that's a good way to start to familiarize yourself with the names and of some of these ETFs and the various areas of the market that they cover. All right, so let's conclude sort of the ETF coverage there, and I'll go in and we'll have a look at the ASX recent signals. So we go back to watch list, and we come in here and under ASX recent signals, and there's only a handful of stocks that are currently in the recent signals. So these have been triggered within the last 7 days, and we can organize this list either alphabetically. We could come over here and organize it by saying, okay, let's get the buys to the top, or let's get the sells to the top. But my preference is really just to click on any one of these and come into the list and start having a look at sort of the signals that are occurring. So this particular stock, not one that I follow closely, but nevertheless I've put a resistance line there. A little bit mindful that it's not so much a real bearish structure. To me, it looks like it's been in a reasonable uptrend, and it's probably more consolidating sideways, but I'll continue to track it and just see how price action starts behaving over the next few days. OneView Healthcare, so the same thing there, but probably a little bit out of the area that I follow, mainly sort of top 50, top 100 stocks that I concentrate on, but I've put the resistance line in there and I'll just keep an eye on that one. Super Retail Group, I think there's probably an opportunity emerging here on the short side. I think somewhere sort of close to sort of where it is at the moment, maybe up to this previous high here at sort of $9, $9.10. I'm just watching this and keeping an eye on the shorter term momentum indicators and just seeing if we get a key reversal, so meaning where the stock sells off going into the close and closes on its lows. So that might be one there for you just to keep on the watch list on the short side. Kathmandu, so we've had a buy signal here on this one at around $2, and I've just shuffled the support line in under that. So if these sort of this area of the market fits sort of with the ideas that you look at, buying something like this and running a stop loss below the recent low, may be a sound strategy to give some thought to. And the oil ETFs, I continue to like that. And for me, that just reaffirms my interest in Santos and Origin, and we'll have a look at a couple of those shortly. I've shuffled a support line in here on this one, but again, not a stock that I follow too closely. And then back to the reject shop. which we have the higher low there at around 590 on this. So we'll see. I've put the support line there, and again, we'll see how that sort of plays out. VRT, so $5.44. I've put the support line under that one. And then the physical gold ETF. So out of the signals so far that are catching my attention, it's the O, which is the oil ETF, and this particular product, which is the ZGOL. And just coincidentally, they're both ETFs, but this particular one, as I mentioned, is exposure to being long gold and short Aussie dollar. And there we are, back to the beginning of that recent list. Now, next, what we'll do is have a look at the stocks that were in review last week, and I've added a few more to the list, and I think these are sort of some of the optimal sort of trading or investment opportunities coming up this week. So CIMIC Group, I continue to like this. I'm drawn to CIMIC because of its exposure to infrastructure and the increasing budget allocation towards infrastructure spending. And the stock's very tightly held. The Spanish parent company holds, I think, something in the order of about 85% of the available stock. So there's not a lot of stock on issue or free float on the market. So somewhere around this sort of $36 in a really weak market to actually where we are at the moment, $40, $41 looks like a good buying opportunity for CIMIC. So that's one that we're starting to build a position in. Santos, I continue to like this as one of the preferred exposures to the energy market. I think the possibility of a takeover bid, obviously Santos rejected the recent offer of $7, and I think on probability the likelihood of seeing an increase offer at maybe $7.25 or $7.50 is looking increasingly likely. So I think buying Santos down here, well, we like that. Tabcorp is one that we've been speaking about regularly on the blog. We had the algorithm buy signals in Tabcorp down here at around this 420 level as the most recent signal. The stock's now pushing up to 460. Obviously, the opportunity here with Tabcorp is 6 months ago they merged with Tats Group. The August earnings result will be the first announcement to the market of what the business looks like as a combined entity. I think there'll be a lot more assurances from management around the cost synergies, and I think net it should be a positive announcement for the price performance of Tabcorp, that August earnings result. So we're wanting to stay long Tabcorp coming into that result at the end of July, early August. And it's possible that sort of fair value for Tabcorp's actually closer to around $5 than where it sits at the moment. So we'll keep an eye on that and stay long that coming into the August result. Origin Energy, so I think Origin's done a good job. They've cut the dividend, which has helped them to pay down debt. So they were running about $10 billion, about $9.5 billion of debt. They've cut that down, I think, at the end of this year to around $6.5 billion. We've seen the stock continue to make higher highs and higher lows. And I've looked at sort of the most recent low here and put a support line under that at 928, and I think on a momentum basis you want to stay maybe long the stock with a stop loss below 928. For clients where we own it at lower levels, you might want to think about selling a covered call. I think the upside for this is probably maybe 1050, but certainly on any pullback you want to start thinking about accumulating Origin again. But in saying that, I think Santos is my preference over Origin at the moment. CYB, so this is the Clydesdale Bank, which was spun off from NAB, which is a UK-based bank, and they're in the middle of making a takeover bid for Virgin Money, which Virgin Money will end up effectively owning about 30% of Clydesdale. That's just to give you an idea of the size of the acquisition that Clydesdale's looking at making. But I think it probably sets up a growth profile for Clydesdale that's better or more attractive than probably any other bank stock listed on the ASX. So that's one for you just to keep an eye on. And again, you can see there I've put the support line at $5, and you probably think about running a stop loss below that. Star Entertainment, maybe not as convincing as Tabcorp coming into the August earnings result, but I still think there's probably a margin for Star to provide positive commentary to the market, and this sell-off is a buying opportunity. So keep an eye on the shorter-term momentum indicators, and as these start to turn back up, you might want to think about a long position in the market in Star Entertainment there. Amcor, so probably this is maybe one that you would want to complement with a covered call strategy. So I think Amcor is likely to get the business back on track and growing and return to growing earnings at, say, somewhere between maybe 6 to 8% per annum. And I suspect sort of this $13.50 to $14 range ends up being a good buying opportunity when you look back 2 to 3 years out from now. My preference for this is just to simply be a buyer of it where it is at the moment and sell maybe the $14.50 calls into December, where you're bringing in income from those plus getting exposure to the August dividend. And I think that's sort of a low-risk way of playing Amcor. IPL, we're seeing an improvement in DAP prices, and at $13.50, I think IPL is good buying, so keep that one on your watch list. Crown Resorts, I think you're seeing Crown have a renewed focus on cost control, and I think you've probably got another 12 months of support coming through the earnings, driven by a more disciplined approach to running the business. So at around this level, I think it's good value. A little like Amcor, I think maybe the upsides could be a little bit limited, but to me, sort of $14 to $14.50 is probably a fair price range for Crown into the back half of this year. So buying it here and selling a $14 call achieves the same outcome. You're effectively getting an exit price of $14.50 as a result of the call premium, and you're getting exposure to the August dividend. And if you don't get exercise, you're generating around a 10 to 12% annualized cash flow from holding the stock, selling the call option, and collecting the dividend. IFL, so this is probably at the higher risk end of the spectrum, but worth keeping on your watch list. Just simply, it's had a big sell-off. This is acquirer of ANZ's financial services arm, and at around this $8.50 to $9, I think it ends up being a good buying opportunity there. So again, just keep an eye on that one. Watch the short-term momentum indicators. You might want to think about sort of a long position in that. If you're a little bit cautious on it, could run a stop loss below the low there of $8. IAG, so we don't see this sell-off too often, IAG. So it's been in a terrific uptrend. It's one of the best performing stocks in the top 20 model, in the ASX 20 model portfolio. It was added into the model here around $5.70, now trading $8. Almost touched a high of $8.50. But this little sell-off at the moment, I think, is an opportunity to keep an eye on this early to mid this week. And maybe if you see a retracement back down to $7.75, I think that'll be a good buying opportunity. For income investors, buying it at that level, letting it rally back to $8 and then selling maybe an $8.25 or an $8.50 call into December, collecting the August dividend, again, you're delivering around 10 to 12% cash flow plus exposure to the franking credit there on Insurance Australia Group. And finally, Medibank Private, MPL. I think on this sell-off, there's a buying opportunity emerging here, so you want to keep a close eye on this. Friday's close was a little bit weak, and whether it comes back down and tests this low here of sort of 280, 275, we'll just have to wait and see how the market shapes up over the next couple of days. But buying Medibank at or near this level, and then as with Amcor and Crown, selling call options out into December, stripping the income from the call option and then getting exposure to the August dividend and the franking credit, you're delivering around 10 to 12% cash flow from an opportunity that I think has fairly limited downside risk. So when I think about Amcor, Crown, Medibank, I'm drawn to those names because I think the downside risks are limited. Some of the other names we looked at, like CIMIC, Santos, Tabcorp, CYB, Star Entertainment, they're names that probably have more growth opportunities, and we probably wouldn't be in a rush to sell call options over those ones. All right, so to conclude today's, I just want to jump into the model portfolio, and we'll just focus on the top 20 today. We didn't cover that last week. So we click on model portfolio. We come in here to the top 20. These are the stocks that sit in the model at the moment. And there's a history of the recently closed positions and the percentage gains and the number of days that we held them. So to toggle through the top 20, we come in here under watch list, select the ASX top 20, and let's just move through these and we'll chat about the broader trends in the market. Now, AMP's, I think the prospect of this company being broken up is looking increasingly likely. The advisory side of the business will probably be merged into some other organisation, and the managed fund side of the company is probably what will stand the test of time. I think that's the sort of, if you thought about it in a good and bad aspect of the AMP business, their managed funds business is a high quality part of the operation. But AMP is probably getting down to a point where it's oversold, and we'll just keep an eye on this. It's as to the trigger for when some renewed buying interest comes into AMP. ANZ, so the banks are probably coming into a period over the next 3 months where maybe they do get a little bit oversold and have a technical bounce, but it's hard to see them rallying back and making new highs. I think the pressure to the banks is such that the story becomes more maybe the risks around them slightly cutting dividends, difficulties growing revenue, and maybe at the margin some concerns around the credit cycle turning less in their favour than what it has been. So it's just hard to see the conditions that really propel the banks higher. But inevitably they probably will get oversold coming into the result. I think prior to the 30th of September, the final report needs to be handed down from the investigation into the Australian banks. And I think that may be a period, sort of peak pessimism, if you like, where the banks get oversold and then have a rebound or a rally. But again, I just don't expect that rally to even take out the highs of where we are at the moment. BHP, so continue to like this, very bullish, higher high, higher low, and I think its exposure to the energy portfolio continues to be a plus for BHP. It looks like they're going to achieve a better price than the market had anticipated for their onshore shale assets in America. The number being touted at the moment is around $9 billion. So BHP will keep their offshore assets that they bought, but sell those onshore assets. That may then create an opportunity for excess capital to be returned back to shareholders through a special dividend. The risk here is probably iron ore prices, although export of iron ore from Pilbara was, I think, up 4% on the same time last year, so continuing to push new records. Iron ore prices at the moment have pulled back a little bit from their highs, and it's probably hard to see the catalyst to really drive iron ore prices too much higher. So I suspect that BHP is pretty close to full value, and it's only really if oil prices rally $5 to $10 that you then get that next leg higher in BHP. Otherwise, we like it, but recognise it's pretty close to resistance. Bramble, so you've seen this company disappoint on the, they went from growing earnings at around 8 to 10% per annum to now only growing earnings at 3%. They historically have traded on a high dividend yield, so you're starting to see a little bit of a readjustment. But even at the moment, Brambles is on 17 times earnings and a 3.4% dividend yield. Owning it here and selling covered calls. I don't think there's a whole lot of downside in Brambles, so it's probably closer to turning around than it is to continuing move lower. CBA, so I think I've already covered sort of the view across all the banks. I think it's not too dissimilar regardless of the name. CSL also been one of the best performing stocks in the model portfolio, but to put in context, it's now trading on a 39 times PE and a 1.2% dividend yield, so maybe starting to get a little bit crowded as a trade here. CSL, clearly they're growing earnings at one of the faster clips within the top 20, top 50, so CSL's growing earnings at around 20% plus per annum, but on those valuation metrics is looking a little expensive. Insurance Australia Group, we looked at this one, so I think this is a buy on the pullback, so keep an eye on that one. Macquarie's just, they delivered a great earnings result, $2.5 billion. The stock's probably at, say, 16 times earnings and a 4.5% dividend yield. You'd expect it's in for a period of consolidation. NAB had the sell signal that was removed from the model and continues to be under pressure. I think any bounces will be limited. So when you look through these names, clearly sort of your resources and these energy names are showing the best technical structures in the market, and Origin has that bullish pattern there that we're drawn to. Rio likewise, higher highs, higher lows, looking good there. But again, not sure how much upside's left now. If iron ore is unable to trade too much above where it is at the moment, it seems to be sort of pulled back from its highs and bumping along sideways. South 32, this was removed from the model, so we're just mindful, just watching this to see if you actually get a more of a rollover technical pattern there at around that $4. Centre Group, so some of these yield sensitive names, we've had the algorithm sell signals, so the conditions for these sell signals to be accurate would require US interest rates to move higher and further selling to occur in these yield sensitive names. But Centre Group's had a good rebound, driven by partly by a $700 million share buyback and what looks like underlying earnings growth of about 4% for Centre Group, so quite a reasonable outcome there for a property trust. Suncorp, cautious on this one at $14, and I think you think about that one on the short side. Transurban, another one of these yield sensitive names. To me, this is more moving sideways, but we just got to be a little bit cautious that we're not in the early stages of these yield names actually rolling over as a function of US interest rates moving higher. So we're just keeping an eye on that closely at the moment. Telstra, so the saviour for Telstra shareholders will be their Investor Day, I think on the 20th of this month, where we're looking for commentary out of the company around a more aggressive cost cutting exercise, or maybe even something as significant as breaking the business up into two separate components. Westpac, all the banks the same. Wesfarmers back at the top end of this resistance range, so it spent 4 years trading between sort of this $37, $38 range and $45, $46. It does look expensive, but I think supported by the prospect of shareholders voting in favour of spinning the Coles business off, and the thought that some of that capital might make its way back in the form of special dividends to existing shareholders. So I think it's likely to stay at the top end of this range, but is looking a little bit expensive. Woolworths, we don't mind Woolworths growing 8 to 10%, but let's have a look at the valuations on it just to keep it in context. There's 22 times earnings, and it's now on a 3.5% yield based on next year's earnings. So it does appear to be close to full value. So if you own this name, selling covered calls, I think makes sense as a way of driving some extra income out of it. Woodside, so this was removed from the model. It was under algorithm buy signals. Now it's under sell conditions, which is interesting. So therefore, sort of our preference within the energy space remains Santos, Oil Search, and Origin. And with the case of Woodside, we're just watching this to see whether we actually get a sort of roll over lower and maybe another buy signal a little bit further down the track. And there we are, back to the index. So I'll conclude today with a look at the XJO, and then we'll leave it at that for today. So at the moment, the index has made a run back at that 6150 high. We have the support here at 5,964. The resources continue to look like they're probably going to hold up okay. I think the banks remain soft, so it's hard to see where the catalyst is for the index to really make another run at this. And we've got a backdrop there where I think the US tech sector's looking as tremendous as the earnings growth is in that area of the market. It is looking a little bit expensive, and you would think we're at a stage where you get a bit more of a consolidation pattern in the US market rather than a continuation of the move higher. And I think that then lends itself probably where our market more bumps along around this 6,000 level for another few weeks. And it'll certainly be an interesting earnings season kicking off late July. Thank you for listening in, and I look forward to chatting again soon.